Okay, and thank you to the conference organizers. It's been quite a really nice, diversified mix of theory and empirical papers, and also policy discussions yesterday, which I very much enjoyed. So I've been in Sweden for 2 weeks, and it's been a very eventful 2 weeks. When I arrived on my Lufthansa flight, I developed an eye problem. I developed a small hole in my retina. And so it was very serious. You have to get in and have that seen. So I went in and I was seen, and they laser surgery fixed it within 3 hours, and it was only $350. So my hat's off to the Swedish health system. Very nice. And then another $350 for the checkup. So I don't even care if I get that covered by insurance or not. The second thing that happened was yesterday was my last day as department chair in the Department of Finance. So those two events may be correlated with each other. I'm not sure. All right, so onward to our paper, our empirical paper, and I'm very pleased to co-author a paper with, again, with my former PhD student, Nitin Kumar, and his colleagues, Shashwat, and I have also published. And then now we have Apurva, who's equally excellent. And so what I taught these three young scholars is the thing you want to do when you get into a team is to make sure the other team members are both very smart and very hardworking. And so I'm following my own advice by having these three guys, very smart and hardworking, much more than me for sure. So thank you. All right. So we are going to focus on a very granular analysis of how economic policy uncertainty affects flows by asset managers. And we think this has a lot of, as I'll explain in the coming slides, we think this is a really great way to look at things that is much more granular than has been done in the past. We find that, or there are statistics that show that global institutions, which include mutual funds, pension funds, endowments, have a whole lot of money invested globally. There's just a lot of money sloshing around. And I think one of the panelists late yesterday afternoon mentioned that the stock of capital in a country is also important. I can't remember if that was Eminem or the speaker, the Reichsbank governor. And we agree wholeheartedly is these big capital reserves, or not reserves, but big capital funds, invested in funds, plays a big role, we think, in a lot of things that go on in country economies and so on. So we're not going to solve all that stuff, but we're going to look at how changes in economic uncertainty affect the flows of these funds to and from their so-called destination countries. And I'll explain that a little bit more in a minute. But with that level of investment, we could expect that the actions of these institutions is going to affect a lot of things. The stability of financial markets in different destination countries, especially the not so deep destination countries, maybe not an open small economy like Sweden, which tends to be pretty stable, but certainly emerging market countries are going to be affected greatly by asset management flows. And so what we want to do is we want to figure out what effect local country-level economic policy uncertainty has on the flows or on the investments to those countries by these global asset managers in aggregate, okay, and also individually, okay? And secondly, we want to know not only if economic policy uncertainty increases in Brazil, and I'm the Fidelity Overseas Fund with an investment in Brazil, we want to find out if that affects the Fidelity Overseas Fund's investments in or sensitivity to economic policy uncertainty in Turkey or in Albania or wherever, okay? In other words, do EPU shocks transmit from one country to another via these big global institutional investors? And as you might expect, the answer is going to be yes for both, or I wouldn't be here. It would be an uninteresting paper. But I'll try to see if I can convince you guys of this. And we certainly would be very happy to hear comments and complaints and criticism. Looking forward to Roberto's comments as well. Okay, so I think the two things that you can bank on that we do that's different from other studies, and there have been a lot of great studies, of course, on flow of funds and policy uncertainty and macroeconomics and so on. I think the two things that we look at that are unique is we look at country by country economic policy uncertainty, and then we look at investors holding by holding of these different country security stocks, okay? And so with this, we get, a massive, M by N amount of combinations of funds, and I might as well advance to show. We have 18,000 institutional funds across 77 host countries. These are the countries of domicile of those funds. So it could be a Brazilian fund that invests globally, a Turkish fund, Indian fund, whatever, US fund, whatever, across 77 host countries. Across 21 destinations. And we use the 21 destinations that Nick Bloom and co-authors have provided EPU estimates from text analysis. I've done text analysis in a couple recent papers of news, and I'm convinced that that is a very rich source of information, much richer than information. I'm sure Nick must agree with this, is that here's where you get high frequency information rather than slow moving macroeconomic variables, which are often very difficult to interpret and so on. Of course, a big minority of our funds are UK, US, and Switzerland, but we still have a lot of funds that are in other countries as well. A lot of G7 other countries, as well as non-G7 countries by the 77 host countries. You can certainly tell that, and for 20 years. Okay, so what do we get? We get a whole lot of funds, and we get a whole lot of destinations. And so we get a lot of degrees of freedom here. And so we can look at several things, which I'll briefly describe to you about how different funds or funds in aggregate invest in a particular destination country, as well as how they invest or disinvest in other countries upon a shock in the economic policy uncertainty in that particular target country. Okay, lots of papers, and I don't have time to go over them. But Kasperzik et al., I think, is an example. It's related to ours. Marson's paper et al. Looks at total global risk and allocations. That's great, but we want to look at country by country risk, EPO, I should say. Okay. Many others, and I think in general the literature has focused on kind of broad-based flows into and out of countries, and maybe by sector, by mutual funds, by hedge funds. We want to look on a fund-by-fund basis and see what we can learn from that. And we think we can learn more from that. And think of this, one of the advantages of looking on a fund-by-fund basis is you have a natural control. So if you can use a fund and time fixed effects, you can look at a single fund. You can look at the Fidelity Overseas Fund at 1 quarter in 2015, okay? And whatever is happening to that Fidelity Overseas Fund is kind of controlled for. It's all the same for all their holdings, okay? So you can, to some extent, control out by using those fixed effects, fund times time. You can control out a lot of unobservables. So this is really, I think, an important point, is we can do within fund analysis, which helps to ameliorate a lot of the concerns about omitted variables and other things going on and so on. And there's literature on information, currency, culture, familiarity in terms of Steve has something here as well, a contribution. And this is obviously important for investing as well. This is not a focus of our paper, but I'll show you some results that we have. Okay, capital flows. So this is the main object of our paper, is measuring capital flows by a fund, okay? And so into or out of a country. So flow FCT is the flow by Fund F, Fidelity Overseas Fund. Country C, Brazil, okay? At time T, fourth quarter 2015, okay? That's what the flow FCT is, and we directly measure this by the normal flow computation. You can remove the 1 plus RCT in order to normalize by beginning of period assets. We've done that in robustness. It doesn't matter too much, okay? So this is the flow by the manager into or out of country C at quarter T, okay? And that's our main, this is our main, I guess, variable of interest is how this flow from Fund F, country C at quarter T varies with shocks in economic policy uncertainty in that country lagged 1 quarter or at the end of the prior quarter. Okay, and one thing to remember is that EPU C is a normalized variable. So we don't measure the economic policy uncertainty of a particular country based on its level at a particular point in time. We measure it, we normalize it by its time series average. And the reason for this, you might wonder why we do this. The reason for this is there could be some, preferred habitat by funds. Some funds prefer to invest in high economic policy uncertainty countries by nature, and maybe they're better at this or whatever. The EPU is going to only measure the quarterly shock away from the average in terms of standard deviations, away from the average for that country. So if they are in the United States might have, as a destination country, the United States might have a very big shock as well. So it's shocks that matter and not levels. Okay, and we think this, again, is a better way to do that. Okay, we like 2 ways of doing this, I think, of fixing effects. One is fund times time. I already mentioned that to you. That allows us to focus on the Fidelity Overseas Fund at the end of 2015, and allows us to look within the Fidelity Overseas Fund for differences. We also like destination fixed effects across all funds for a particular country. And across all time periods, in case there is a country that is different in some way in the long run in terms of their financial structure, capital controls, things like this. That's what that is there to soak up. And then we have various control variables, interest rate spread, equity returns, all lagged, industrial growth, currency returns, just in case those things are affecting this flow variable. The flow is the thing beta is the thing we're gonna be after here. How much does a shock of 1 standard deviation in the EPU affect the flows to or from a country from a particular fund, okay? So here's the first baseline results, and take a look at this guy here, minus 1.276. It says that it is a very statistically significant result that a 1 standard deviation increase or 1 standard deviation shock increase in economic policy uncertainty in any country causes investment in that country to decline by 1.276%. Okay, you might think that's not that much, but these guys are increasing their investment by 1.39% because these global funds are growing, okay? It basically kind of stops the investment in that country, okay? If it's a 1 standard, 2 standard deviations, even more, you reverse out of that country, okay? It'll be interesting to see, funds are constrained. Funds, portfolio weights have to add up to 1. And generally funds, global equity funds, don't put money in cash or borrow. So it'll be interesting to see how that affects, how that rope that connects these different holdings, destination holdings, affects EPU from one country to holdings in a different country. Coming soon. Okay, so we do this, before I go to that, we do this on the extensive margin too, using a little bit more powerful, I think, metric of aversion to a destination. We measure the exit, whether a fund exits completely from a particular country. That would mean that they are very averse, I think, to this country. And we find that the probability of a fund exiting is positively correlated with EPU shocks, okay? Bigger the EPU shock, the more likely you're just gonna sell out everything from the industry, from the country. Permanent exit means we haven't seen it come back into that country anytime in our sample period, and entry is reduced too. And I think it's pretty clear why exits are more sensitive than entries are, is because when you think about entering a country, you have a lot of choices, but when you think about exiting, you have your portfolio, and that's all you have, okay? So it's gonna affect your impressions about your portfolio much more greatly. And once again, fund and time fixed effects, destination fixed effects all across, those are the ones that we like. Okay, so I'm not gonna have time to go over this, but we have, in our paper, we have a metric of quality of institutions within a country, transparency, legal and democratic protections, as well as common language, common ethnicity. We borrow these from other papers, other fantastic scholars who have developed these things, luckily for us, similar legal systems, and so on. And we find that these particular factors actually mitigate to some extent the reaction to EPU shocks. So there's still a reaction of US Fidelity Overseas Fund to a shock in the UK, like Brexit maybe, but it's ameliorated to some extent, it's reduced to some extent because of commonalities between Britain and the US, okay? All right, now let me talk about home bias, which I promised, and flight to safety. Okay, so first of all, we want to find out, is there home bias? Home bias is a widely documented phenomena among all investors, including institutional investors, amazingly. And so we want to find out, does this reduce or mitigate the scare factor of a shock in economic policy uncertainty? And so here's economic policy uncertainty by itself, the familiar negative sign. The higher the uncertainty, the greater the outflows, or the lesser the inflows into that country by that manager. And here is the home bias coming out here. This is just a 1-0 variable that says, is this investment in the US for Fidelity Overseas Fund, or is it not in the US? That'll be 1 and 0. And then the cross variable, the interaction variable, which is what we're interested in whether home bias exacerbates or mitigates. And we find that it actually mitigates to some extent the flight from a country that has an positive EPU shock. Okay, so there's some evidence so far, prima facie, that there is home bias. But sorry, one more thing I need to say here is, I think I went backwards the wrong way. There we go. So we split this down into US and G7, of which the US is part of, and non-G7 countries, okay? So remember, these are funds that are in the G7 and invest in their home country. These are funds that are in the US that invest in the US. And these are other countries outside of G7 that invest in their own country, like Brazil, I guess, okay? And we find very weak results for the non-G7 countries. So we start to wonder, is this really a home bias effect, or is this a flight to safety effect? Because it's all happening in G7 countries here. And none of the home bias, the so-called home bias, or favoritism seems to be happening outside. So this could be that there is not home bias, but there is a flight to safety during an EPU shock to your country. Okay, and so let me skip this and go right to the results. And so what we find is that sure enough, if you have destination EPU it's a home destination, it's a stock from your own country, the results are pretty weak. They're not statistically significant. There's something there, but it's not very strong. If you look at let's see, destination EPU times destination equals G7. So if you have an investment in the G7, it turns out that your flows increase. And I'm sorry, these are all. Then if you look at home, funds that have their home in the G7. And they also have an investment in the G7, also show insignificant results. So this seems to indicate that it's it's basically an effect of G7 and not homeness is what these variables are trying to say. Okay. So it looks like flight to safety. There may be some home bias here, but flight to safety seems to be a stronger story, at least the way we measure things. Okay, spillovers. I find this to be really interesting. So we do a one country left out shock to do this. Really clever, I think, empirical design. We look at a fund's weights in different countries at time t, and multiply by that country's economic policy uncertainty shock at time t. That's what this is. Sum those up to come up with a fund level EPU metric, okay, for country C. Country C is the only one that's left out in this computation here. So the idea is the right-hand side captures all the EPU shock from everything else. The left-hand side captures the left-hand side covers is a computation of the EPU in that country, and then we want to use that to measure the impact on flows. Okay, and so here's the fund level EPU. Here's fund level EPU elsewhere. Maybe we can focus on this guy here. Again, has destination and fund time fixed effects. Those are our preferred specification. And we find that fund EPU elsewhere decreases flows into country C. So this exacerbates, outflows. So they pull flows, they pull money from other countries outside when they're having trouble with the rest of their countries. Let's see. I thought there was one other one here too, but I'm forgetting. But anyway, the net effect is that yes, there is contagion from one country to another within a particular fund. They become more skittish about their investments when their other investments have had shocks in their other countries have had shocks in EPU. Now we do a stock level, and I'll finish with this because I think I'm running out of time. So how does this all translate into the stock level? You guys are all asset pricers, some core finance people here too, but we all care about how can I make money on this, or can I make money on this, and what are the policy implications? So we build a stock level EPU factor or metric. We only do it currently for U.S. stocks, and this is because we have really good characteristic information for U.S. stocks, but in actuality, we should expand this to other non-U.S. stocks as well. So we build a metric that measures this fund level EPU. If you remember what that is, that's across all countries now, not a leave one out country. This is a fund level EPU. I'm sorry, it is ex-USA, I'm sorry. So we measure the economic policy uncertainty of the fund outside the U.S., outside its U.S. investments. And we weight those by how much the fund puts into that country. Okay, we come up with, and then we sum across all funds. This gives us a stock level. So if it's NVIDIA, we know this metric will measure how exposed is NVIDIA to funds that being held by funds that have a high level of exposure to shocks in EPU. Okay, so this is really kind of an asset pricing test here. Once we build this, then we want to regress an alpha. We measure a 4-factor alpha on stock EPU, this thing up here. The null should be that the alpha should be 0. There should be no effect if markets are incredibly deep and these global funds don't have any price impact. Okay, but it turns out that the metric is not. This is the specification I like best because it has the controls and the well, let's see, this one or this one is fine. But we find that, and these are percents per year, 4-factor alphas. There are some real impacts, negative impacts on stocks that are most widely held by funds that have had a last quarter shock in their economic policy uncertainty. And the numbers are big, and we're currently trying to figure out why is this. Maybe it is a price pressure effect that they're pulling out of everything. Maybe they have a budget for economic policy uncertainty, and there is correlation between the U.S.'s uncertainty or shocks and the rest of the world. The U.S. kind of drives the world to a large extent. So maybe it makes sense is that during those episodes, you can see certain stocks really get hit, like if it were NVIDIA, for example. Okay, let me stop there. We have taper tantrum as a case study, but I think the message is pretty clear here. We find, I think, really unique results with this portfolio level, fund level, destination, fund domicile pairing, and using NIC's EPU on a country level basis. I'll stop there. I told you all this stuff. I'm going to stop in the interest of time, and I want to hear Roberto's comments anyway. Thank you.
Thanks a lot. The discussant is Roberto Tubaldi from BI Oslo.
All right. Thank you for inviting me to discuss this paper. It was a very nice read, and it was fairly hard to come up with some sensible suggestions since they do a lot of stuff, a lot of robustness. They study very different mechanisms. But what I will focus on in my discussion is try to connect more the different mechanisms. So I find that in the current version of the paper, all the different mechanisms seems to be a little bit fragmented. And I'll try to lay down some alternative stories that might hold here, and I will urge Russ and the co-authors to use more the granularity of the data. I usually start my discussion with the big picture. Unfortunately, we don't need this today since it's basically the big picture is the talk we had yesterday from Nick. So I won't spend time in convincing you that economic policy uncertainty is important. So now the next step, if you are a mutual fund guy or an institutional investor guy, is to ask, does this economic policy uncertainty matter for the allocation of funds? And this is, of course, the question of the paper. So they try to answer this question by looking at very granular data on global portfolio holdings, and they match these holdings with the economic policy uncertainty measure of NICs. And they find that when the economic policy uncertainty increases in a destination country, then the flows of institutional investors to that country decrease by 1.27%. Importantly, this is true when the destination country is a non-G7 country. They have a plethora of robust results that I don't want to spend time in explaining, but what is more important are the economic channels. They start by looking at the home bias, so they try to figure out whether when the economic policy uncertainty is high in the home country of the fund, then still the fund withdraw money from that country. They find that is not the case, but they find that this is true only for G7 country. So they extend this argument by saying, well, maybe this is flight to safety. And that's what they actually find. And they find that the flight to safety story is actually stronger than the home bias. Then they look at the cross-section of the countries, of the destination countries, and they find that the negative sensitivities of flow to the economic policy uncertainty is driven by some variables like the informational transparency, how close is somewhat the culture or the geopolitics of the home country to the country where these funds are investing. And then in the final section of the paper, they try to see whether there are some spillovers of this story to other countries. So my comments, well, I will try to switch your attention in the first two comments from the holdings of the fund, from where this fund invests, to the client base of this fund. Then I will talk a little bit more of how this fund trades, so we'll talk about the market time, and then I will conclude with some minor comments. So first, now by reading the paper, one question that I was having was that, do fund outflows matter? So, well, we know that uncertainty, again from Nick's paper, is high during recessions. Now, but it's also true that during recession, the clients of these funds have higher incentive to withdraw money. Now, at the same time, the paper shows a spillover effect. So meaning that when economic policy uncertainty is high abroad, then I still withdraw money from other country. But this to me looks like a proportional liquidation of the holdings driven by the outflows of the fund. So maybe it might be more a liquidity story rather than an information asymmetry story. So what I would suggest to do here is maybe to look at the outflows from the fund, not really where the flows of the fund go in terms of holdings, to exclude that these outflows increase with economic policy uncertainty. Another thing that might help is to differentiate across type of institutions. For example, the mutual funds might be more exposed to the risk of an outflows. Finally, it might be nice to see some anecdotal information, some evidence about the clientele of these funds. Where do they get the money from, right? And then again, you can use the stock level analysis to study whether these are actually proportional liquidations of the holdings. All right. Second comments, again on the clientele, but this time is not gonna be on the clientele of these global funds, but of the clientele of local funds. And this comment comes from three results in the paper that I find a bit at odds with one another. One is the home bias. So we saw that when the economic policy uncertainty increases at home, you tend actually to increase your holding at home or to do nothing. At the same time, we saw that at least for the United States, when the economic policy uncertainty increases abroad, there's an underperformance of the stock. But there's a high correlation between the economic policy uncertainty in the US and the economic policy uncertainty abroad. So here is another story. Given this correlation, well, when the economic policy uncertainty increases in the United States, then the local funds that might have a local holdings and a local base of the clients, then they might experience some outflows. And hence, they put some pressure on the stocks. And this is consistent with the second result. Now, at the same time, the global fund might be less exposed to these outflows risk because they are diversified. So they might buy, and that's where the home bias result is coming from, they might buy the home stock at a cheaper price, at a fire set price. So they provide liquidity to the home funds. So again, an analysis of the outflows of the clientele of these funds, I think it's important. Finally, the last comment I have, it's more on the trading of these funds. So this is a result that Russ did not show in the presentation, but they have a final section of the paper where they try to disentangle whether this behavior on this global institution leads to higher performance. And they do that by looking at the covariance between the economic policy uncertainty and the flow. Under the idea that if you have a negative covariance, then it is the case that the institution is withdrawing money from the fund when the economic policy uncertainty is high. And they find that for funds at the bottom, so funds that do withdraw money when the economic policy uncertainty is high, there's a slight outperformance. So the magnitude is not big, but it seems to be there. Now, I'm wondering, why is this the case? Do they, in a sense, they time the market and they cash in the risk premium that is embedded with this economic policy uncertainty? And why is the outperformance so modest? Is it an average effect, so we have some funds that actually can exploit these and make money because they are more specialized? Some other funds are not. But in general, I believe that addressing this question is quite important, since you want to know whether these global funds create or destroy value for the clients, right? And looking at more in depth to the performance and to this market timing story might be important. Again, here, what might help is a stock level analysis within fund. At the same time, what I would look at is the dynamic of trades, right? So you want to see whether they close out their position just in time, whether the flows relationship goes back to normal in a sense that they start investing again when the economic policy uncertainty is not really important. All right, so this was, I guess, my last comment. I have a series of minor comments that I will skip since we are close to lunchtime. So I'll stop here. I thank you for your attention, and I wish all the best for the paper. Thank you.
And I will also be
Thanks a lot.
very, very brief since people want lunch and coffee and so on. Roberto, great. Thanks a lot. Great stuff. First of all, fund outflows. We kind of think that we've controlled for that by using fund times time fixed effects. And so we're measuring within fund, within quarter, variation to shocks. But we still think there is a role for investor flows in this. And we've talked about that a bit, so that's very smart of you to think of that. Correlation, I was just thinking about that yesterday, correlation between EPU. If you remember the fund level EPU metric, we treat EPU between countries as if they're independent from each other. We should actually have a correlation structure in there too, right? Yeah, because we're talking about a risk measure, right? So absolutely correct. Market timing, yeah, the fund performance tests are the tests that we are least confident about, and we can do a whole lot more. You might notice those came up kind of recently, and yeah, we're not exceptionally proud of those yet, but we're going to keep working on them. And Apurva, did you have any comments?
Yeah, so I mean, just one comment about the stock level result, that it also, these are very recent results, but the fact that the US stocks are kind of underperforming, if those are exposed to the global uncertainties via the holdings by the global institutions, is maybe it's a pricing pressure, not a flows pressure. So because we do not see US getting hurt in terms of capital flows so much when the global uncertainty, I mean the uncertainty outside US goes up, but it could be still that the increased risk aversion at the fund manager level hurts the prices. So we are still kind of opening that channel up to see what exactly is driving the US stock results. But yeah, thanks for the suggestion.
You asked all the right questions, for sure.
So we have time for a few questions. Go ahead, Jakob.
Yeah, I wondered, the results are very strong, and I wondered whether to put the paper in the behavioral column or in the rationality column, because I don't see any rationality for the phenomena that you document. Roberto said it's like you have fund flow when there is the EPU changes. It's not when, it's following. So you have it T-1 and T. So the
but it tends to persist though. So, but it tends to persist. Fine, but I'm saying that the EPU has changed. Rational investors should incorporate it immediately in price. What is gained in period T+1? You move the fund. You already incurred the loss or the gain. So I don't see any rationality behind the results except a behavioral kind of a... Or maybe we shouldn't be lagging EPU.
No, but then that's another question. But if you have T-1, EPU T-1, and I mean, the results stand in its own right. I mean, it's not that you shouldn't. You have the results, and I don't understand them based on rationality. It's just behavioral story. If anybody has rational explanation, I would be happy to hear.
I think that we could test whether this is rational or not by looking at whether the positions that are tested in countries with EPU shocks exposed underperform.
Mm-hmm.
So that would be a rational...
That's kind of what our last test was trying to do.
It means that the pricing takes time to evolve rather than being...
No, but perhaps the fund has made some analysis such that based on private information predicts even worse performance.
But it cannot be consistent in all countries. Let us say EPU in Brazil has risen. Prices in Brazil adjust.
Yeah, but the
What
funds
do I
are
gain?
specialized, right?
No, wait.
So if a fund is specialized on Brazil...
No, let's take Brazil.
Yeah.
EPU in Brazil has risen. Prices adjust promptly.
Yeah.
What do I gain by moving funds out of Brazil?
No. Now,
Well, one reason could be you have retail investors. It's not clear. I agree if it was Goldman Sachs prop trading was behind all of this, then that might be true. It could also be that it's retail investor, or it could be moral hazard on behalf of traders. So I'm Goldman Sachs trader. You're totally right, but I get fired if my fund falls more than 20%. It only falls more than 20%. I get called into the MD's office. He said, "You idiot! You invested in Brazil after there was a coup." So I agree. Under total rationality with that, any moral hazard all the way up. But I suspect there's some combination of some that are retail traders.
Retail investors.
So whether that's behavioural or
It could be, or more lags of EPU to see if it persists, shocks persist.
It may be you're Goldman's, you get fired. If your fund falls more than 20%, you're fired. In which case, as soon as EP goes, I agree, it may not maximum. It truncates the left tail at the cost of losing the right tail, but you care about the left tail. That may be. I think we're aligned. I was going to ask on the flight to safety. Is that basically a flight to the US?
Yes, it's more of a flight to the U.S. We find it in G7, but it's much stronger in the U.S. Yeah, exactly.
That was the weird thing that you saw in the financial crisis and COVID, that all the money rushed into the US.
But the interesting part is we still find pricing pressures.
But that's also totally irrational. And coming to Jakob's, the fact that there's bad news in the US and all the money rushes in, it's kind of the same. bigger puzzle.
Subsequent fund flows are done as the contemporaneous.
Do we have time or just relating to the correlation across CPU? You can orthogonalize them, right, on the global one.
Sure.
And then having just the
Sure. You can have a
orthogonal
single
component
factor
of that.
EPU model. Yeah.
So that
Right.
would sort out some of these.
Sure. Of course. Yeah.
I am wondering whether you can really test the difference between home bias and flight to safety. Because I would think that most of your funds are either from G7 countries or are from Bahamas and Luxembourg, where there is nothing to invest, right?
Mm-hmm.
And that wouldn't give you the power to take out the G7 country and then look at whether high uncertainty is.
Yeah, well, there are a whole lot of French funds and there are a whole lot of British funds.
But that's G7.
G7, you're saying outside the G7. Yeah, I don't know what fraction are outside the G7.
You're absolutely right. The small fraction is, the bigger fraction is in G7, but there is, we believe enough fraction in the, at least to test statistically outside G7 as well. But
yeah, you should.
But I hear your point. Yeah.
Yeah, good point.
All right, then let's close the session. Thank again the presenters and discussants for their great effort and talks.